Thanks very much. And it's great to be here. I think, in particular, it's great to be here with real business people. I like to call you guys kind of real economic risk takers. We here doing a lot of analysis, a lot of theoretical analysis of the market and then world. But you guys are really taking the risks out there, which is actually what we speak about, and that's really empowering and driving individuals, businesses, and societies forward. So it's great to be able to speak to you guys. Thanks to Pete and to George. Honored to share the stage with George. As Pete said, he is actually a mentor of mine in years gone by and still to this day. So it's good to be here. I like to think of myself as I'm the main speaker today, following on from George. And Pete says, I work on asset allocation in an investment context. The presentation here today, though, is something slightly different. Of course, bringing those insights from financial markets to you guys. But I've been asked to speak on business cycles and capital structures. So it's a bit more. It is a bit more theoretical and philosophical. But as I said, I will try all the way through to make it practical and useful. Because my goal here is. I guess similar to George, there is a slightly sobering tone, I will admit, but it's to educate and to empower you guys about these trends that we see in the world today. And as I said, to understand cycles, to understand the role of central banks in these cycles. George has obviously touched on that, but I will add a few additional insights. And the purpose of each of these different cycles, why they exist, and how central banks have been involved in these cycles, and then trying to answer the question of where we are in the cycle today, and what that means for capital allocation, for us as individuals and businesses and society. So cycles, I like to think of cycles as kind of as natural as night and day. Historically, life centered around cycles, seasonal cycles. Even each day is a new cycle that we enter into, and humans go through a cycle throughout life, from youth to adulthood to old age. These are all different cycles that we go through. They're the natural rhythm of life, and each one presents an opportunity and a risk. In youth we have an opportunity to get an education. We've also got a risk not to get that education. And as I said, we have the opportunity to plan appropriately, knowing what these different cycles are that we're going to enter into in life, in the day, in the seasons. Even just an example of the seasons. You plan for winter. Historically, people would have focused life heavily around the seasons. They'd plan and they'd stockpile for winter, but winter would serve its purpose itself. To go indoors, to re-strategize. Potentially go into more intellectual pursuits. So I think it's just very important to note right from the start. I'm starting a bit esoterically, but just making this point that cycles are natural and each of them serve their purpose. And we as humans, we have the opportunity to respond to these, as I said, to plan appropriately. But we've got two broad choices: to smooth out these cycles and to plan appropriately. We can also exacerbate the cycle. As an example, I'd go into debt today to buy a house, smoothing out my future income in order to spend it today. That would be smoothing out my long-term economic cycle. But I can also exacerbate the cycle. I can go into debt today in order to spend it on party and alcohol, maybe fancy clothes, resulting in great times today and potentially a hangover when I get a little bit older. So debt is often the tool that we use in order to smooth or exacerbate our cycles. That's it. So now I've broadly spoken about cycles generally. The next section, I'd just like to move more into this business cycle, economic context, and tie it to central banks. So, the U.S. Federal Reserve came into being in about 1913. Don't worry, I won't take you through a long history lesson, but essentially after a period of lots of bank runs in the U.S., the governments there wanted to smooth out the cycle and bring an end to bank runs. And conceptually, this makes a lot of sense. mean, a central bank, what do? During bad economic times, they can lower interest rates, encourage people to take out more debt, stimulate the economy, and boost economic activity. And during good economic times, they can tighten interest rates a little bit, reduce the rate of debt growth, and dampen economic activity a bit. So conceptually, this makes a lot of sense. And I understand that entirely. But in reality, it doesn't really work this way. Humans are inherently impatient. And maybe it's just as a quick example. I mean, sir, if I ask you, would you want that glass of wine after this presentation, or do you want it now? Maybe now. We want things now. We want things in the present. Humans have this inherent desire to want things today, and that's natural. That's absolutely natural. But politicians, in particular, I think, fall into this trap. They want outcomes in their term in power. They want to see action in their 4 or 5 year election cycle. Not too concerned about what might take place in the future. And this natural inclination, I think, becomes very clear when we look at cycles and we look at central bank policies in particular. I mean, one of the aspects to interest rates that George didn't touch on extensively is the way that an interest rate essentially gives us an indication of our preference between now and the future. And if interest rates are very high, that discourages us from taking out lots of debt today, and it encourages us to wait and look and wait for the future and wait to buy that car or whatever it might be. Whereas a lower interest rate encourages us to take action and take out debt and spend money in the short term, so that a lower interest rate is a sign of increasing short-termism, whereas a higher interest rate is the opposite. And I think it came up in a few of George's slides, but I mean, very easy to describe. Globally, we've seen interest rates decline, of course, going through these cyclical patterns, as George has spoken about, but the trend since the 1980s has been firmly lower and lower interest rates, which, and the average across the developed market, just for an indication, has fallen approximately from 1980 up at about 15% to 1% today. So a dramatic lowering in interest rates, which, as I said, for me, it tells a lot of different things. There's always a lot of information contained in financial market variables, but one of the things it tells us is this increasing short-termism, this desire by authorities to use lower interest rates to encourage people to take out debt and to stimulate economic activity in the short term. And as a result, it's no surprise that you see debt levels trend significantly higher. Over the same period of time, since the 1980s to today, debt to GDP ratios across the developed world have increased from below 40% to above 120%. Japan sitting at above 200%. The United States above 100%. So increasing levels of debt as we lower and lower interest rates. So, I mean, this, and maybe just to also draw the South African example. Yeah, I am a lot in this presentation focused on the United States global developments, but it's important to reiterate that we're part of the same trend. If you look at South African interest rates relative to US interest rates, they follow the same trend. Yes, our rates are slightly higher, and as I agree with George, South African central banking policy is not nearly as problematic as we're seeing in the globe, but the trend is intact. South African interest rates have fallen from above 20% in the 1990s down to 7% today. So the trend lower in interest rates is not only a global one; it's also a local one. And the point I'm trying to make here is that central banks have become the integral factor in the business cycle. So we now currently associate business cycle expansions with periods of lower interest rates and rising debt levels, because that stimulates the economy. And we associate business cycle contractions with higher interest rates and lower rates of debt growth. So instead of having this original conception that central banks would be there to smooth out the cycle, in reality what we get is that central banks are actually the creator of the modern business cycle. And it's very, very important to be aware of that. So returning maybe to the original analogy, we talked about these seasons, and we talked about cycles, and each cycle having its purpose. So what is the purpose of the different aspects in an economic cycle? We have this economic cycle of approximately 5 to 10 years. Of course, it's not an exact science. There's all sorts of factors that influence it. But we go through these economic cycles of approximately 5 to 10 years globally and in South Africa, heavily influenced by central bank policy. And what is the purpose of the different aspects? In particular, what's the purpose of recession? And maybe once again, if I can ask another audience question, it's not easy to see everybody, but is anybody willing to answer a question? If I ask you, what's the first word that comes to mind when you think of, there's not less light over here. The first word that comes to mind when I say the word recession, what's the first word that comes to mind? Anyone? Bad. It's bad. It's a bad thing. Recessions are associated with high unemployment, joblessness, weak economic growth. So understandably, we don't like the idea of recessions. But what are we missing? If we say that, the cycles, the different aspects to cycles all have their purpose, and that might be the same thing with the economic cycle, what is the purpose of the recession time, of the winter time in the economic cycle? And so what are we missing? And in order to understand this, I think we've got to pull back the lens to something we've already mentioned. We've already established, quite simplistically, that lower interest rates will encourage a stimulation in an economic cycle, encourage more debt growth, and things look good in the economy. Businesses go out and expand, and they conduct activity. And some of these businesses are great ideas. They're wonderful investments. Maybe they last for many years to come. But are all of those businesses good ideas? Or are some of them just good ideas because we've reduced interest rates? We've reduced the cost of capital. Because in reality, what we see through each economic cycle, these cycles of 5 to 10 years approximately, we see bad investments, or what Austrian economists will call malinvestments. Maybe just as a quick example, during the dot-com bubble in the US, there was a company called Pets.com. And these guys basically they were selling pet food, dog food on the internet, and got caught up with this internet mania during 1999, 2000, 2001. I think in 1999, I've got a few of the short stats here. They were making a revenue of approximately $600,000 and had advertising expenses of $12 million. This was in 1999. But because of the hype and mania around the time and the flushness of funding for investments, because of these very low interest rates, they were able to secure $83 million in IPO funding around that time. So, and as the cycle turned and interest rates rose through 2001, 2002, and the dot-com bubble burst, Pets.com, got liquidated and went out of business. But the point just to make here is that they are, in each cycle, there's always examples of great businesses, wonderful businesses that get invented, but there are also examples of very bad investments that only really take place because of this lowering in interest rates, the lowering in the cost of capital, which makes marginal business opportunities seem much more attractive than they would otherwise. And if we look around the world today, I'm not a stock analyst, so I'm not going to try and predict exactly what the malinvestments are out there. But I think that there are potentially ones that we need to look closely at. It just draws a nice relationship to the past. some of these tech unicorns that we see around the world. Peter mentioned a few of them earlier, but these companies, a lot of them are getting similar activity to what Pets.com did. Lots of IPO funding, but they're not necessarily turning a profit. And as I said, I'm not to say that they won't. Maybe they will. I mean, maybe they will in the future. But clearly, there's an aspect here of low interest rates and the low cost of capital providing a lot of funding into businesses that might not necessarily have existed if it wasn't for the low interest rates. And I think it's very important for us to highlight that when these malinvestments take place and we discover them and we liquidate a company like Pets.com, this is a good thing. We won't want $83 million to be allocated to online dog food. We want that capital to be allocated towards productive, sustainable businesses that are really going to advance society. Sure, it might be painful for some of the individuals that lose their job through the process, and clearly that is an uncomfortable reality. But even for those individuals, I think we have to make the point that it's a good thing for these mistakes to be uncovered. As an individual, do I want to be working at Pets.com for 30 years and then only 30 years down the road find out that this was a terrible idea and now have to change my whole profession and my whole life strategy? No, I would rather find out that mistake as soon as possible so that I can invest my time productively, sustainably into something that's actually going to be worthwhile to myself and society. So the winter time and the economic cycle, recession and the economic cycle, yes, while it's associated with a lot of bad connotations, the point I'm trying to get across here is that recession is actually economic healing process. It's actually the economic healing process in society where we liquidate bad investments, these unsustainable allocations of capital, and reallocate them towards things that are actually productive, actually sustainable. And that's a good thing, both for society and for individuals. Okay, so where are we in the cycle today? Well, a normal business cycle positioning, I would say, okay, well, are we in the springtime of the economy, the summertime, the autumn time, the winter time? Are we going into recession? Are we seeing the green shoots come around? And I want to actually maybe add an additional layer here because, and it's linking up a few of the points that we've already touched on. What I see is that this linear understanding between recession equals bad, recession equals unemployment, combined with central banks' appreciation that they are such important aspects to the cycle, has led them down a road of quite paternalistic thinking where they want to banish recessions because recessions equals bad, so let's try and avoid them altogether. But in avoiding them, we never go through this full economic healing process of uncovering these bad investments. And it's taken us to a point where I almost see us in this extended autumn phase, never quite getting into the recession, never quite getting into that winter time where we reallocate capital. And as a result, we never quite see the green shoots coming up on the other side. And I think some of this probably makes a bit of sense to some of you guys as real business owners. You're thinking to yourselves, when are these good times going to roll through? When are we going to start seeing those green shoots, those improvements? And I guess what I'm saying to you here is that the central authority's consistent desire to try and banish recessions from our economic lexicon, this is actually a key problem that we are faced with in the world today. Okay, so what are the kind of the implications? What are the implications for capital allocation and for us as just individuals? Well, the first one is, if we're not liquidating these bad investments, it's no surprise then that productivity rates are on the decline. If you look globally, once again, since the 1960s, 1970s, back then, annual growth in output per the hours that people would work was growing at 5-6% year on year. It was very strong rates of productivity growth, and that's fallen down to around about 1% today. So productivity is declining, and it's Sometimes, once again, we get caught in micro examples where we're seeing people being less productive. But sometimes it's good to pull back the lens and understand these macro trends that are actually driving society to be less productive. Of course, it doesn't mean there aren't pockets of productivity. Some manufacturers, car manufacturers in China or Japan, incredibly productive businesses. What I'm saying here is from a society-wide perspective, if we're not willing to take the pain of getting rid of some of these bad investments, then we need to bear the consequences of having broad economy-wide reductions in productivity. And what's the route out of this? What is the route out of this? Well, one, of course, we could grow a lot more, but as I said, I think that's a little bit tricky given the trends in these productivity rates. We could write off a lot of these bad debts that we have globally, but politicians have shown themselves not to want to take this pain. South Africa, of course, we have our examples of the state-owned enterprises, Eskom, SA, amongst many others. But that's just a South African example. Of course, there are lots of global examples too. The global financial crisis in the US, they decided to bail out many of the banks. So politicians the world over are unwilling to kind of take this pain. And as a result, and George touched on this, is they continue to turn towards central banks in the hope that they might be able to create inflation and stimulate our way out of this problem. And modern is maybe not the right word, but some of these new age economic thinkers are talking about, they look at the world today, they look at monetary policies, and they're frustrated. They're frustrated with some of the impact that we've seen on society and some of the wealth gaps that have developed, and justifiably so. Quantitative easing policy was specifically targeted to try and boost asset markets, to boost equity markets, property markets, in the hope that would impact broader economic growth. But when you boost those asset markets, we shouldn't be surprised that the people who hold those assets benefit. And who holds those assets? Well, richer people, educated people, people in urban areas, those are the ones who hold those assets. It wasn't any sort of nefarious intention of the policy, but you shouldn't be surprised about the unintended consequence that you do see an impact on wealth gaps when you're targeting a policy to try and boost asset prices. So these New age economic thinkers see this and they're frustrated with these low interest rate quantitative easing policies. But unfortunately, rather than respond and say, okay, well, what we need is actually to take them away, that's really what we need, they kind of want a piece of the pie for themselves. They want to try and use a similar concept to take money towards people, towards wages. And that's why we see increasing talk about this modern monetary theory, or MMT. You might see it in the news from time to time. Basically, it's just quantitative easing for the people. That's the way I think about it. Previously, quantitative easing would get money towards banks, which would boost financial markets, and the hope that would filter through into the rest of the economy. And now what these policymakers are trying to do is take money and give it directly to governments, and then they can maybe spend it on social welfare programs. Unfortunately, a number of these trends that I've spoken about here will remain intact. We're still not really going to be taking the economic pain. We're still not going to be trying to reallocate capital. We're not going to be trying to raise interest rates, which is what we probably require. But it will probably mean something different. Maybe we do start to see these MMT programs having an impact on CPI inflation effectively. But that's something to watch out for. Okay, then more specific, I think, insights for us as individuals. The first one feeds on directly from this wealth gap concept, is that with reducing economic growth and productivity levels, we shouldn't be surprised that social tensions in society are on the rise as a result. Economic growth, productivity growth, these are the real social harmonizers. So when allow me an oversimplification for a moment, when I look around the world and see Brexit and Trump and even the EFF in South Africa, of course, all of these political phenomena have their own micro explanations and reasons to exist. But in my simplistic view of the world, I see frustrated people, frustrated with this kind of perpetual economic autumn that we've entered into. And I'm not hugely surprised by some of these social tensions that do arise in the globe today. And I think the important insight for us as individuals here is just to be aware of these trends and be less kind of emotionally frustrated when we see, Donald Trump or Julius Malema tweet on a day-to-day basis. And then coming down to our businesses, well, clearly, utopian economic growth forecasts are likely to be proven incorrect. And as a result, marginal business opportunities aren't going to be particularly attractive in the current environment. Of course, that doesn't imply, though, that risk-taking is not appropriate. I mean, risk-taking is a critical component to human development, but the way I see it is just that risk-taking is going to be slightly different going forward to what it has been historically. And maybe as an example, when I look at my parents' generation, they followed a very tried and tested path. They got an education, they went to university, they got a career job, they bought a house, invested in the stock market. All of these strategies worked out so well that they're almost sold to the youth today as these are low-risk options. And I mean, I'm not making the point that these investments can't have good returns to us in the future. I mean, from an investment perspective, these growth assets in property and equity still are some of the best returners over the long term. But the risk-return trade-off is not the same as it has been historically, for precisely the reasons that I'm giving you here in this talk. We've been through a cycle of lower and lower interest rates, higher and higher debt levels. This has boosted equity markets and property markets. So, linearly thinking that historical relationships are going to be, can we just extrapolate them into the future, and it's a low risk investment option, and not just investment option, but life decision to make, I think needs to be called into question. We need to be asking more kind of deep searching questions about the risk-taking that is appropriate for current times. I think it relates a little bit to Peter talked about the kind of the red versus blue ocean, and the current conditions are particularly not good for your red ocean type and business opportunities. Historically, with growth rates strong, you could still fish in that pond with lots of other people out there, but currently with broad growth opportunities not where they could be, it's much more risky to follow those types of strategies. Another insight is that, clearly we are being told as a society with these lower and lower interest rates to favor consumption. And this is, you can see this come through in the numbers. If you look at the US economy, they're increasingly a consumption-focused economy. So it's not, once again, it's not just a South African trend. We know that to be the case in South Africa too. And this is problematic because long-term economic growth is not based on consuming. It's producing first and then consuming. So once again, business opportunities that are heavily focused on consumer sectors of the economy, we just need, it's not that they can't do well. Of course, there's all sorts of opportunities that lie beneath the surface in an economy. I'm talking from big, broad macro trends here, but clearly there's been a bias towards these consumption sectors of the economy, and we've got to be aware of the risks that are contained in them as a result. From a leverage perspective, as George said, interest rates could go a bit further. In South Africa and globally, that's where the trend is heading. But from a business perspective, and looking at this cycle, it's unlikely the cycle will just continue indefinitely. We need to be cognizant that these businesses just built on leverage alone, trying to just capitalize on low costs of capital in order to and having very utopian forecasts about economic growth, it's a dangerous strategy at this stage of the cycle. And then specifically from an investment perspective, it wouldn't be surprised if we start to see more interest in real assets that can specifically store value. I mean, we've been through a cycle where your more financial market assets that benefit from liquidity and low interest rates have benefited. And as I said, I'm not ruling out the opportunity or the possibility that can continue, but the conclusion that I drew is this: we've got to be aware that the risk-return trade-off is not the same. So as a result, these real assets do start to get increasing interest. And I know that Chris Becker spoke to you yesterday about these digital currencies, Bitcoin and a number of other digital currencies. And of course, these assets come with numerous risks, regulatory risks, volatility risks. People really need to go home and do a lot of due diligence as individuals. But it's very exciting and also not surprising that we're seeing digital stores of value arising. These are both a response to current conditions and an opportunity in current conditions if all of the right due diligence is conducted. And then I guess the last point from an investment perspective is just, we've been through a period of quite suppressed volatility because we've, as central authorities, we've repeatedly used these low interest rate policies, lots of debt to smooth over the cycle in a very extreme way, trying to get rid of volatility altogether. But once again, that can't remain intact indefinitely. I mean, the cycle always eventually turns. So assets which are able to respond to heightened levels of volatility become, a little bit more attractive. And of course, that's an insight both from an investment perspective as well as from a business perspective. Nimble businesses that aren't just following a very certain business strategy that's built on these economic growth forecasts, but are rather nimble and aware of volatility in our current economies are probably stand to benefit more. So bringing a lot of these concepts all together, cycles really are a very natural phenomenon. They've existed, historically, and the business cycle is no different. These 5 to 10 year business cycles that the economies go through in South Africa and globally, and they're very interlinked. Hence why I've spent so much time on the global cycle and the global trends. But the central authorities' involvement in these cycles has gone to such a degree that they basically control the cycle. And although they approach their jobs with, of course, very good intentions to try and solve the problems that we are faced with, a combination of this linear thinking, seeing recessions equals bad, combined with omnipotence and paternalism, has led them to overuse the tools at their disposal and pushed these cycles to such an extent that we've almost entered this extended period of autumn, never quite going into economic recessions because we seem to be scared of the pain that they hold, despite the fact that I hope that you've seen from this conversation that recessions actually truly are the economic healing process that is required in a society and in an economy. But of course, as I said, the cycle won't last forever. Yes, it might extend for a little bit longer. I mean, we can't underestimate authorities' ability to conduct more of these policies. But the cycle won't last forever, and I think that it's our prerogative to understand these trends in order to respond against them. So, despite the sober tone of the speech, I think it's not a doomsdayer's conclusion whatsoever. These trends are intact. In fact, you know them to be true already. I'm just painting the trends and trying to understand some of the broad drivers of those trends. Because it's understanding those trends that is powerful. That's it's that the old adage, knowledge is power. It allows us to have less emotional responses to the number of the trends that we are frustrated with, and it also allows us to position appropriately, to constructively influence others, and to have a very positive outlook as we move from this cycle into the next. Thank you.
Hartlike welkom by Sakeplein. Sake wat? Goeie vraag. Ek sal verduidelik. Sakeplein is eintlik baie eenvoudig. Dit is 'n markplein aanlyn. Lys jou besigheid, lok nuwe klante, kry sakevennote, kom bymekaar in sakekamers en nog baie meer. Om te sien wat Sakeplein en sy mense vir jou kan doen, registreer vandag jouself of jou besigheid op sakeplein.com. Sakeplein. Skep waarde, maak wins.